In technical analysis, a gap refers to an area on a price chart where no trading activity occurs between two consecutive trading periods, resulting in an empty space or gap. Gaps typically happen when significant news or events impact a stock or market overnight or during periods when trading is halted. Understanding gaps and their implications can significantly enhance a trader's decision-making ability and profitability. Common gaps, also known as area gaps or trading gaps, occur frequently and without significant market implications. These gaps typically form within existing price ranges and are quickly filled by subsequent price action. Traders usually disregard common gaps as they rarely indicate substantial changes in market sentiment or direction. Breakaway gaps signal the start of a new trend and usually occur after periods of consolidation or price congestion. These gaps represent strong market conviction and often coincide with substantial trading volume. A breakaway gap can indicate significant fundamental changes, such as earnings surprises, merger announcements, or regulatory developments, marking the beginning of a sustained price move. Runaway gaps, also known as measuring gaps, occur in the middle of a strong trend, signaling continued market momentum and indicating the trend's strength. These gaps typically represent intense buying or selling interest and are usually accompanied by high trading volume. Traders often use runaway gaps to project future price movements and confirm trend continuation. Exhaustion gaps occur near the end of a prevailing trend, signaling potential reversals or trend exhaustion. These gaps indicate the final surge of buying or selling pressure and are often characterized by extremely high volume. Traders closely monitor exhaustion gaps as they frequently precede significant reversals, offering valuable trading opportunities. Gaps provide critical insights into market psychology and investor sentiment. They can indicate significant shifts in supply and demand, offering traders valuable opportunities for entries, exits, and risk management strategies. Recognizing and correctly interpreting gaps enables traders to capitalize on market moves efficiently, manage risks effectively, and enhance overall profitability. Incorporating gap analysis into your trading approach significantly improves your ability to anticipate market trends, identify high-probability trade setups, and make informed trading decisions. By understanding the different types of gaps and their implications, traders can gain valuable insights into market dynamics and potential price movements. This knowledge allows them to develop more effective trading strategies, manage risk more efficiently, and potentially increase their overall profitability in the markets. By mastering the art of gap analysis, traders can stay ahead of market trends and make more informed decisions in their trading activities. Accurately identifying and analyzing different types of gaps is crucial for traders aiming to enhance their market analysis and decision-making processes. Each gap type, common, breakaway, runaway, and exhaustion, carries distinct implications and requires unique analytical approaches. Common gaps typically occur within established trading ranges and lack significant technical implications. These gaps usually fill quickly as price movements revert to previous trading levels. Traders recognize common gaps by their occurrence during periods of low volatility and absence of substantial trading volume. Traders generally disregard common gaps, focusing instead on more meaningful market signals. However, recognizing common gaps helps traders avoid misinterpreting insignificant price movements as meaningful breakouts, enhancing overall analytical accuracy. Breakaway gaps represent significant market events, marking the start of new trends after prolonged consolidation periods. Traders identify breakaway gaps through notable price movements beyond support or resistance levels, accompanied by significantly increased trading volume and strong momentum indicators. These gaps frequently occur after critical news events or fundamental developments, indicating substantial shifts in market sentiment. For example, a breakaway gap following positive earnings reports typically signals strong bullish momentum and investor confidence, providing traders with reliable entry points for long positions. Analyzing breakaway gaps involves carefully assessing volume, momentum indicators such as RSI and MACD, and post-gap price follow-through. Strong confirmation signals validate the breakout's authenticity, enabling traders to confidently capitalize on emerging trends. Runaway gaps occur during strong, ongoing market trends, reflecting sustained momentum and reinforcing trend direction. Traders identify runaway gaps by their occurrence within clear, established trends, typically accompanied by high trading volume and consistent price momentum. Analyzing runaway gaps includes assessing trading volume, price action consistency, and momentum indicators to confirm trend strength and continuation potential. Traders frequently use runaway gaps as measuring gaps, projecting potential future price targets based on gap measurements. For example, a runaway gap appearing midway through a bullish trend, supported by increasing volume and robust momentum signals, strongly indicates continued upward price movement. Traders strategically position themselves to capitalize on ongoing trends, adjusting positions as market conditions evolve. Exhaustion gaps occur near trend extremes, signaling potential trend reversals and market exhaustion. These gaps typically feature extremely high trading volume, significant price movements, and divergence indicators signaling diminishing trend momentum. Traders identify exhaustion gaps through volume spikes, momentum divergence, and rapid price reversals following initial gap formations. Analyzing exhaustion gaps involves closely monitoring RSI and MACD indicators for divergence signals, confirming weakening momentum and potential reversals. For instance, an exhaustion gap forming after an extended bullish trend, characterized by extremely high trading volume and subsequent price reversal, strongly indicates bullish trend exhaustion and potential bearish reversal. Traders proactively adjust positions or initiate reversal trades, capitalizing on anticipated market moves. Traders integrate gap identification and analysis into comprehensive trading strategies, utilizing volume analysis, momentum indicators, and price action analysis to validate signals and optimize trade decisions. By effectively distinguishing between different gap types and accurately interpreting associated market signals, traders achieve higher analytical precision, greater decision-making confidence, and sustained trading success. Effectively trading gaps involves clearly defined entry and exit strategies tailored specifically to each type of gap. Utilizing systematic approaches enhances trading accuracy, minimizes risks, and optimizes profitability. Breakaway gaps provide strong entry signals, typically marking the start of new trends following periods of consolidation. For example, traders observing a bullish breakaway gap accompanied by increased trading volume, a bullish MACD crossover, and RSI moving upward enter long positions promptly, anticipating continued upward momentum. Runaway gaps signal robust trend continuation and represent excellent opportunities for traders to capitalize on ongoing momentum. For instance, traders identifying a runaway gap within an ongoing bullish trend, validated by high volume, strong RSI readings, and supportive MACD signals, confidently enter long positions aligned with trend direction. Exhaustion gaps provide valuable entry opportunities for reversal trades. Traders recognize exhaustion gaps by extremely high trading volume, momentum divergence signals, and rapid price reversals. For example, traders detecting a bullish exhaustion gap followed by volume spikes, bearish momentum divergence, and subsequent price reversal enter short positions strategically, positioning themselves for downward moves. Establishing profit targets based on gap measurements, significant technical levels, or projected price moves ensures systematic and disciplined trade exits. Traders typically set profit targets at key support or resistance levels, previous swing highs or lows, or gap-based measured move targets. For instance, traders identifying a runaway gap during a bullish trend might set profit targets at measured move distances equivalent to the gap size, ensuring optimized profit taking. Trailing stop-loss orders dynamically adjust exit points, effectively managing risk and protecting accumulated profits. As prices move favorably following gap trades, traders incrementally tighten trailing stop-losses, locking in gains while allowing winning trades to continue. For example, traders initiating positions following breakaway or runaway gaps strategically implement trailing stop-loss orders to preserve profits, adjusting exit points based on evolving market conditions. Utilizing momentum indicators such as RSI and MACD enhances exit timing precision. Traders exit positions when RSI signals overbought or oversold conditions. MACD crossovers indicate momentum shifts, or volume analysis signals diminishing market participation. For instance, traders exit bullish gap trades upon RSI reaching overbought levels above 70 or bearish MACD crossovers, signaling declining momentum, effectively managing profits and reducing risks. Consider stock XYZ experiencing a bullish breakaway gap, accompanied by substantial trading volume, bullish MACD crossover, and upward RSI movement. Traders enter long positions immediately, placing initial stop-loss orders below the gap level. Profit targets are set at previous resistance areas or measured move targets based on gap size, systematically securing gains. In another scenario, stock ABC forms an exhaustion gap following an extended bearish trend, characterized by extremely high volume, bullish momentum divergence, and rapid price reversal. Traders strategically enter long positions, placing stop-loss orders below recent lows and setting profit targets at significant resistance levels or measured move distances, optimizing profitability. Employing structured gap trading strategies for entries, exits, and risk management significantly enhances trading effectiveness and profitability by systematically approaching different gap types, strategically placing stop-loss orders, and setting precise profit targets. Traders confidently navigate market opportunities, effectively manage risks, and achieve consistent trading success. Effectively managing risk and avoiding common pitfalls are crucial components of successful gap trading. Employing comprehensive risk management techniques and recognizing frequent mistakes significantly enhance trading stability, capital preservation, and long-term profitability. Properly determining trade sizes based on account size, risk tolerance, and market volatility is fundamental for effective risk management. Traders typically adhere to risking no more than 1% to 2% of their total trading capital on any single trade, ensuring long-term sustainability and minimizing potential losses. Careful position sizing enables traders to withstand market volatility, maintain trading stability, and effectively manage potential adverse market moves associated with gap trading. Strategically placing stop-loss orders near critical gap levels, support or resistance points, or recent market extremes significantly limits downside risk. Proper stop-loss placement protects traders from substantial losses due to false signals or market reversals. For instance, traders initiating positions following breakaway gaps place stop-loss orders slightly below gap levels for bullish gaps or above gap levels for bearish gaps, effectively managing risk exposure and capital preservation. Always evaluating potential trades based on favorable risk-to-reward ratios ensures profitability and trading efficiency. Traders typically target trades with at least a 1, 2, or 1, 3 risk-to-reward ratio, ensuring potential profits significantly outweigh potential losses. Systematic application of risk-to-reward ratios dramatically improves trading performance, ensures capital optimization, and promotes consistent profitability. Actively managing trades based on evolving market conditions, technical indicators, and price action helps traders dynamically adjust positions to minimize risk and maximize profitability. Regularly reviewing open trades and adjusting stop losses or profit targets based on market developments ensures effective trade management and risk optimization. Chasing gaps involves prematurely entering trades immediately upon initial gap signals without adequate confirmation from volume, momentum indicators, or price follow-through. Traders frequently experience losses from chasing gaps due to insufficient confirmation signals and higher susceptibility to fake-outs. Avoid chasing gaps by systematically confirming gap authenticity using comprehensive technical analysis, ensuring robust validation before initiating trades. Ignoring crucial technical indicators such as volume, RSI, MACD, or moving averages significantly increases vulnerability to false signals and fake-outs. Comprehensive technical analysis provides essential validation signals, enabling traders to confirm gap reliability and avoid deceptive market moves. Traders must incorporate detailed technical analyses, including indicator confirmations, to effectively validate gaps, minimize risks, and enhance trading accuracy. Neglecting comprehensive risk management practices such as proper position sizing, strategic stop-loss placement, and risk-to-reward assessments significantly amplifies potential losses. Traders failing to implement robust risk management strategies remain vulnerable to substantial adverse market moves associated with gap trading. Consistently employing thorough risk management practices ensures effective capital preservation, promotes trading stability, and enhances long-term profitability. Consider stock XYZ exhibiting a bullish breakaway gap confirmed by increased volume, strong RSI, and positive MACD signals. Traders entering long positions strategically place stop-loss orders below the gap level, ensuring optimal risk management and capital preservation. Profit targets are set using favorable risk-to-reward ratios at critical resistance levels or gap-measured move targets. Conversely, stock ABC experiences a bearish exhaustion gap characterized by high volume, bearish momentum divergence, and negative MACD signals. Traders initiating short positions manage risk through optimal stop-loss placement above recent highs, adhering to favorable risk-to-reward targets at significant support levels, or gap-based projections. Effectively managing risk and recognizing common pitfalls significantly enhances gap trading success. By employing comprehensive risk management techniques, avoiding frequent mistakes, and systematically validating gap signals, traders confidently navigate market complexities, optimize profitability, and achieve consistent trading performance. Like, subscribe and share for more insightful trading strategies and tips. Disclaimer: the information provided in this video is for educational purposes only and does not constitute financial advice. Always perform your own research or consult a professional advisor before making any trading or investment decisions.